sequence of return risk. Today we're going to talk about what it is and how you can mitigate it with a customized, tailored, handcrafted investment plan. As you head into retirement, how you invest and how you withdraw is going to be very important. And one of the things that's going to be very different adding to your wealth is what's called a sequence of return risk. And so here at Petros Family Wealth, we want to arm, educate you, and teach you. This is not a specific recommendation for you and your family. This is just here to help you and your family enjoy your wealth. So with that, let's go ahead and dive in. So I'm going to make myself a little bit tiny here, just to be able to explain what sequence of return risk is, and then how we manage that at Petros Family Wealth for our clients in order for them to have a more stable and consistent income. So what I have here is two investors that have the same exact average annual return. However, the one on the left had some early gains when they retired, and the one on the right had some losses right away in retirement. So as you can see here, the beginning balance is $200,000, and they are withdrawing 5% per year. And these are all made up examples here. So you can see that the investor here on the left was up 31% right from when they retired. And these are rates of return on the S&P 500. And indexes are unmanaged, so you can't directly invest in these, but it's a good illustration. So that investor had a great start to the year. Second year, down. Third year, great. And you can see that the amount withdrawn was slowly increased as far as a percentage, but they withdrew about $268,000, and then at the end of that 20-year period, they still had $614,000 and change left. Now, what we're going to do is we're going to literally flip the order of those returns. So you see on the right-hand side, the first year is negative 37%. That's the same return that the investor on the left got at the very end of his retirement. Started with $200,000, again started taking that $10,000 a year, slowly increasing to keep up with inflation. But because it started off with a larger drop in the market and in their portfolio, that same dollar withdrawal weighed down on the portfolio more and more. That portfolio never had the opportunity to essentially regain itself, to recapture itself, like the investor on the left did. And so in this example, when the rates of return are literally the same, the average rate of return is literally the same, a much bigger consequence for the folks on the right compared to the one on the left. So how do we fix this, or how do we plan around this? Because we don't know what the next 20 years are going to be, and we don't know if your first year of retirement is going to be a big negative or if it's going to be a big positive. So first I'm going to show you is a non-strategic withdrawal plan. So what we're starting off with is $1.4 million of investable assets. And on the left-hand side, these are, again, S&P 500 returns, which you can't directly invest in, starting in 1973. So this investor had 2 bad years right off the bat of their retirement. So starting with $1.4 million, and then withdrawing $50,000 a year, again increasing with inflation each year. And you can see they have equity assets, so the S&P on the left, but they also had fixed interest assets. So that might be things like either fixed annuities or CDs or treasuries, something on the safer side. And you get, in this hypothetical, you made 4% on that fixed income bucket. So this investor rode the waves, kept withdrawing, slowly increasing those withdrawals each year, and they ended this period, 30-year period, with still $2.4 million, and they started with 1.4. So still made it out just fine. But this is a non-strategic withdrawal strategy. Let me show you the impact of a strategic withdrawal strategy that will be able to incorporate and mitigate some of the risks around sequence of returns. So this next slide, before I show you, I just want you to remember 2.4 million, what they end with after 30 years. Now if you look at this is a strategic withdrawal strategy. And if you look, start off right at the bottom right, 4.8 million. So what did this investor do differently? Even though they started with the same dollar amount, they invested the same way, and the same rates of return, what did they do differently? And in this case, the investor started taking $50,000 out of their equity portion of their portfolio, but because there was a negative year in that equity portion, The next year, that same dollar withdrawal as the previous person, this investor pulled from their fixed assets. So that's over on the right hand side. So you see they pulled $50,500 out of their fixed assets. What that did is that gives the opportunity for the equity portion to recover. But again, the second year, still a negative, a very large negative, 29% negative. So again, this investor pulled from their fixed assets. And when the markets finally started to get some positive, they went back to withdrawing from their equity portion, their more volatile portion of the portfolio. And just switching consistently, where a year after you have a negative return, you withdraw from your fixed portion, so your bonds, your fixed income, treasuries, CDs, money market. If you pull from that during those down years, and then you pull from your equity portions during good years, you can significantly reduce the risk of sequence of returns. And so a lot of times in retirement, there's a thing called asset allocation, where it's a blend between stocks and bonds. But then you can also incorporate a assets to liability model, where you are making sure that those bonds are maturing in the years where you might need them. And if stocks are not performing well, you can pull from that safer investment asset class, in order to allow your riskier assets to recover quicker. And that is a very significant increase. Even though it's the same rate of return, how you withdraw makes a very big difference. So with that, hope you enjoyed, and if you did, please go ahead and like, subscribe, and hit that notification button. Thank you so much.